Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. What a week last week was in equity markets. The S&P had its first 2% upday in more than a year. Of course, it took a 16% one-day gain in the now third largest company in the index to get there. The implied earnings move on NVIDIA, 11% and amounting to $200 billion in market cap, was simply not enough. Eyes locked in on the two-day straddle buyer who'd paid up quite a bit to see the turn card, and impressed Teddy KGB said, "Pay that man his money." Okay, the task at hand is simple. Make further progress on our 25 sayings on vol and risk. I've certainly had some fun with the first 15. Somehow, in the context of this exploration of my market risk philosophy, I've managed to quote both former President Ronald Reagan and Seinfeld hack comedian Kenny Bannia, summoned the wisdom of Wolf of Wall Street's Mark Hanna, and referenced both Morgan Stanley's James Gorman and OptionSeller.com's James Cormier. We value diversification of input over here at the Alpha Exchange. As always, we get our discussion underway with a brief review of history. Our last segment considered some of what happened 30 years ago in 1994. We now take a peek at 2004 and highlight the events that mattered. Well, for me, the first day of 2004 mattered quite a bit. My son, Aiden, was born. He's now 20, nearly 6'6", and loving it out in the Arizona desert. Man, to be a college student again. Along with great sons, some great songs were born in 2004. I'll start with Usher's Yeah, which I won't even attempt to say as he does. And how about Mr. Brightside, the Killer's song about torment, jealousy, and infidelity? The New York Times recently wrote about the 20th anniversary of the song, saying, quote, "It's an intense, dramatic song about the shattering experience of getting cheated on by someone you love. It's becoming something of an anthem, shouted at college football games, clubs, and karaoke nights." Last song I want to mention from 2004 is Five for Fighting's 100 Years. I wound up playing this on repeat for an hour or so upon listening to it again. Quote, 15, there's still time for you, time to buy and time to lose. Amazing. I gotta say, this is a pretty moving tune. Life gets in the way may summarize it well. It's a good reminder to be present, enjoy the here and now. How about world events in 2004? In sports, the nearly 100-year curse of the Bambino was broken as the Red Sox beat the Yankees in the World Series. MySpace, yeah, remember that? Reached 1 million users. But Zuck's Facebook came on the scene the same year. In November 2004, George Bush beat John Kerry to remain in office. HBO released Entourage, Johnny Drama, Eric, Turtle, Vinny Chase. A favorite YouTube search for me is Best of Ari Gold. Jeremy Piven came a long way from playing Dean Pritzker in Old School, didn't he? In markets, the housing bubble was ramping. The Case-Shiller Index rose 14% in 2004. Greenspan would hold the funds rate at 1% until July. It would ultimately end the year at 2%. The share of mortgages that were adjustable rate would soar to more than 30%. Is it any surprise that the 230 yield curve spread was more than 300 bips in 2004? We're all carry traders at what appears to be the right price. And speaking of carry, it's time to get our discussion of sayings on vol and risk underway. My promise remains to get you in and out in 30 minutes or less time than an episode of Curb Your Enthusiasm. Saying number 16 comes to us by none other than Ben Franklin, who said, quote, "Money makes money, and the money makes more money." Brilliantly crafted to describe the virtues of compound interest, let's consider how powerful this can be. Remember the old rule of 72. Take 72 and divide by the interest rate, and you get a good approximation of how long it takes to double your money. At 4%, our initial stack left untouched is twice as large in 18 years. Remember those bad old days post-crisis, when the 10-year note averaged a 2% yield from 2011 to 2021? Now you've got to wait 36 years. That's going to challenge the patience even for the delayed gratification types. The money makes more money. The modern-day application of this alliterative aphorism is to carry trades that spin off income. The carry makes more carry. These profits emerging from short vol strategies are often stuffed back into the same set of trades that delivered them in the first place. Just ask LTCM. Carry is a fascinating concept. Show anyone a trade that has a high likelihood of success, and more likely than not, you'll get his or her attention. I remember pitching a new fund manager some long vol trades in and around 2015, doing my best to support the logic of the trade construction. He listened politely, but ultimately said, "Dean, I need trades that make money today." I understood. Especially as a new manager, you've got to put up numbers early on. Speaking of carry and the likelihood of successful outcomes, I'm reminded a bit of the Goodfellas scene in which Frenchie pitches Henry Hill and Jimmy Conway on the Air France heist. Asked about the risk of execution, grinning from ear to ear, Frenchie says, "It's untraceable." Back to Ben Franklin and compound interest for a moment. Can we contemplate the smallish pickle that USA Inc. finds itself in? The CBO tells us that we should expect to pay $1 trillion in interest alone by 2026, and it will only rise from there. By the way, the CBO forecasts no recession and an unemployment rate that doesn't rise past 4.5% over the next decade. I say that unsustainable debt is like pornography. You know it when you see it. Perhaps some massive technology dividend is coming our way. But in the words of Mohammed El-Arian, the U.S. is driving without a spare. For the U.S., Ben Franklin might say the interest costs more interest. Our next saying, number 17, is ROMO is the risk of missing out. This is a riff on FOMO, the fear of missing out, but focused on the fund manager equivalent. ROMO reflects the call optionality that defines the compensation structure for the asset management industry. Underperformance in bull markets presents a bigger business risk than experiencing large negative returns. We can quickly refer back to the new manager I mentioned and the need to produce an early, steady stream of positive returns. Why hedge when no one else will? There's a lot to ROMO. First, in the words of the amazing Howard Marks, founder of Oaktree. In one of his many memos, what a treat by the way, Howard wrote, quote, "Active investing carries a cost that goes beyond commissions and management fees, heightened risk of inferior performance. Thus, every investor has to make a conscious decision about which course to follow. Pursue superior returns at the risk of coming in behind the pack, or hug the consensus position and ensure average performance. It should be clear that you can't hope to earn superior returns if you're unwilling to bear the risk of subpar results." Amen. There are few more imposing benchmarks than the S&P 500. We can estimate this a few ways, but there is likely $7 trillion of capital explicitly indexed to the S&P. Hit up any stock on Bloomberg and run the HDS function. Vanguard, BlackRock, State Street, and Fidelity are, with few exceptions, going to be the top four. The capital that is implicitly benchmarked to the S&P is likely multiples of that number. Howard Marks's reference to benchmark hugging speaks to a feature of our industry. In Billy Joel's Goodnight Saigon, we will all go down together. The risk of missing out speaks to the long call optionality embedded in how money managers are compensated. Paid a percentage of the AUM, a manager's bigger risk is underperforming during bull markets than in blowing up. In the latter scenario, the market meltdown, the manager can find solace in the fact that the funds to both his left and right also blew up. Everybody's doing it, as Bud Fox told his lawyer buddy Roger Barnes, played by James Spader in Wall Street. The risk of missing out is especially significant when there is so much capital benchmarked both explicitly and implicitly to the S&P. On the latter, I just calculated the rolling one-year correlation between the Fidelity Magellan Fund and the S&P over the last decade. Any guesses? It ranges from 87 to 99% and averages 93%. Today's risk of missing out, given how top-heavy the S&P is and the truly breathtaking performance of NVIDIA, may be without precedent. In 2023, the total return of the RSP, the equal-weighted version of the S&P, was 13.2%. The S&P itself, just about double that at 26%. In 2024 already, the S&P has outperformed the RSP by 430 basis points. Since the start of 2023 till now, I've got the S&P realizing 13 vol and annualizing a 30% return. Let's subtract the risk-free rate from that, and we are still left with just about a 2 Sharpe ratio. The SPY, It's liquid, transparent, and nearly zero cost to track. In the words of Nicolas Cage in Honeymoon in Vegas, it's like unbeatable. By the way, run the analyst ratings function. ANR is the mnemonic on Bloomberg on NVIDIA. 70 ratings, 6 are holds, and the rest are buys, strong buys, or outperforms. There's a credit market version of ROMO as well. For some insight on this, we looked to former Citibank CEO Chuck Prince. Amidst the height of the mortgage bubble in July 2007, he told us that, quote, as long as the music is playing, you've got to get up and dance. And we're still dancing. Now, his timing couldn't have been worse, and he's been widely mocked for being so out of step. New Century had already gone down, as had the Bear Stearns hedge funds. BNP would suspend redemptions on a money market fund in August 07. But I read his words as a statement about being a price taker, not a price maker. If the broad standards of credit evaluation have sufficiently eroded, you must decide as a lender whether you want to play ball or not. They aren't your terms, they are the market's. Take it or leave it. Leave it and you suffer the risk of missing out. And that's a good segue into saying number 18, which is that, quote, risk on and risk off are curious cousins. No, not in the same way that Jonah Hill talks about his cousin in Wolf of Wall Street. No, what I mean is that these two opposites tend to enable one another. Long periods of stability sow the seeds of their own demise. Conversely, it is a risk-off event that, when material enough, creates the opportunity to make a buck in a hurry as the policymakers swoop in to enforce stability, empowering investors to deploy capital on newly cheapened assets and rich and vol. Perhaps we ought to begin to explore this idea by stepping back and contemplating the terms risk on and risk off. The notion is that markets have a set of assets that do well when volatility is muted, but suffer from shocks. The carry-oriented risk-on assets are short vol. The second set of securities, the risk-off category, are haven assets that tend to rally during market vol episodes. We can include treasury securities, gold sometimes, and of course, vol itself in this category. Certain FX crosses have had especially good VIX-like properties at different points in time. The yen was, for years, a strong haven asset. From 2007 to 2017, the JPY was 34% positively correlated to the VIX. A pop in the VIX was consistently associated with a stronger yen. Conversely, the Aussie dollar was 44% negatively correlated with the VIX as capital ran from this carry currency during market shock events. Charles Dickens wrote, "It was the best of times, it was the worst of times." He surely was not a buyer of the XIV in 2017, but his words captured the linkage between risk on and risk off. Show me a trade that makes money, and I will show you one that is attracting assets. Beware the high Sharpe ratio, one might say. The SVXY, the inverse VIX ETF that barely survived Feb 2018, delivered a 183% return in 2017 on a 53 vol. Just a 3.5 Sharpe, nothing to see here. I had Harry Markopolos as the fourth guest of the Alpha Exchange back in 2018. It was the 10-year anniversary of the uncovering of the Madoff Ponzi. Harry said this, quote, "And so I knew it wasn't front-running. I knew it had to be a Ponzi because his returns were basically up at a 45-degree angle. And we don't have 45-degree angles in finance. They exist in trigonometry and geometry. They might exist in physics, but not in finance. We don't get 45-degree return lines." Pull up that SVXY chart from 2017. It's not as 45-degree an angle as Madoff's, but not too far off either. 45-degree angles don't exist in finance. Epic. If you've got to get up and dance and throw caution to the wind in the process, risk on and risk off are on their way to becoming curious cousins. Capital gets pushed into an asset class or specific trade, making it more successful in real time, but dangerously eroding the margin of safety required to sustain a shock. The XIV wouldn't have blown up in 2018 but for the toxic combination of its size and the depressed starting point for the VIX. It was Nietzsche who said, "From chaos comes order." That seems applicable to the linkage between risk on and risk off as well. The best opportunities in markets result from price impairments that are driven by forced selling. There's blood in the water. Let's go kill someone, former Morgan Stanley CEO John Mack reportedly said. I can't help but mention the September 2006 interaction between Amaranth Nat Gas guru Brian Hunter and John Arnold, who ran Centaurus. We learn about the rise and fall of Hunter through the book Hedgehogs. I could have done without the political slant often imposed on this story, but it's worth reading anyway. Stuck with an enormous exposure in the famed HJ calendar spread, Hunter was out of bullets and looking for unwind capital. Arnold, who'd been waiting for this moment for quite some time, prepared a bid that reflected the blood in the water. Let's move to saying number 19. Quote, accident-free finance promotes the selling of accident insurance. There's overlap in this one with a number of our other sayings, including the notion that risk on and risk off are curious cousins. What do I mean by accident-free finance? Well, as mentioned, the S&P just had a 2% move. That's only the third up or down since 2023 began. What if I told you that from June 2003 to February 2007, there wasn't a single 2% down move in the S&P? That's an accident-free regime, and one in which the profit-seeking mechanism of capitalism is going to embolden the sellers of insurance. Competing with each other for the incremental dollar, the insurers drive premiums lower. Now might be a good time to talk about the option characteristics of parking tickets, don't you think? Let's frame out the risk considerations. First, for the most part, a ticket is a binary option. You either get one or you don't, and if you do, it's a fixed amount. How should we evaluate the risk? I might ask myself the following questions. First, how long am I going to be parked without paying? A quick run into Starbucks for a $6 macchiato subjects me to less risk than a 2-hour, 3,000-calorie meal at the neighborhood steakhouse. I'm taking on more short optionality through time in the second. And of course, I need to bring in my historical experience. What's been my success rate in parking without paying? I might further ask myself if there's a time of day consideration in which the hit rate is higher or lower. Ultimately, I need to weigh some implied probability of being ticketed versus both the amount of the ticket and the cost of paying for parking. If you've never been nabbed, you are surely more likely to press your luck. With no incidents of loss, you are emboldened. In markets, the occasional accident is probably a good thing. In forestry, they say that the small fire prevents the big one. I've wondered, mostly for amusement, but occasionally with some degree of seriousness, if the Fed's third mandate should be managing the VIX in a collar between 15 and 25. Call it financial stability or crowd control. Imagine the derivative salesperson getting that call. It's an order from Powell through the Fed's open market desk. Hey, I've got 26,342,752 front month VIX futures to go here at $24.99. Can I stop you on 10 million? Back to accident insurance. Vol selling in all its formats leads to a happy circularity of profits, confidence, and feedback that underpins the growth of the trade. Gains from the short vol trade create capital that enforces the stability of the system, but over time, a bad setup with a low margin of safety results. If you will, please allow me to use this notion of accident insurance to take a brief detour here. It's certainly the case that market-implied vol measures like the VIX are consistently negatively correlated to the S&P. Nothing new here. But let's look at 2022. The S&P fell by 19%, but the VXX, a simple ETF that buys and rolls VIX futures in a mechanical fashion, lost 24%. The next year, this product lost 73%. This year, in 2 short months, it's down 10%. We absolutely suck, the CFO said to the CEO. If NVIDIA's Jensen Huang is worth $70 billion, what is the VXX CEO worth? I forgot. No one actually runs this robotic construction. Stay with me. If, as I've declared earlier, successful trades invite fresh capital, empowering them further, what about the opposite? Perhaps this is the Widowmaker trade. Show me a trade called the Widowmaker, and I'll show you one priced as such. If the VXX could not manage to even come close to breaking even in 2022, when the S&P lost nearly 20%, under what scenario can it be successful? Fair question to be sure, and I'm not sure I know the answer. Sell the straddle and go to lunch is an old options market adage for a reason. But we should note that 2022 started with a second-month VIX future of 22 and finished the year at 15. What about longer-dated implied vol on the S&P? The 1-year 80% put vol started at 28 and finished around there as well. That same 1-year 80% put vol today, That's roughly the Feb 25 4,000 strike put. It's got a vol now of just 22.5%. That puts it in the 10th percentile over the last 5 years, a slice of time that includes 2019 before the pandemic. While that vol tells you most of what you need to know about this option's price, there's something else going on, and that's a one-year treasury rate of around 5%. Puts and calls are priced off forwards. In the case of an equity index like the S&P, the differential in the risk-free rate and the dividend stream. With rates up here, the forward is considerably higher than it was before the hiking cycle. A given put is further out of the money on a forward basis, and as a result, its cost is nominally cheaper. In the case of a one-year option, the 5% rate matters a fair amount. Pull it up yourself on your OV screen. The one-year 80% put costs 120 basis points using current rates, vols, and divs. Move the rate down to 1%, a level we weren't at all too long ago. Freeze everything else, and your price moves up by nearly 50%. So consider this my advocating for a trade that certainly has not paid off recently, but whose price, I suggest, demands consideration. The S&P is at an all-time high. The impact of higher rates may still be subject to long and variable lags. And importantly, the market price of correlation feels far too sanguine. Remember an earlier saying, quote, "There are no bad securities, only bad correlations." One-year implied correlation on the S&P is just 30%. Well, that's a 0th percentile to be sure. Hard to remember as it may be, there surely is a scenario in which stocks experience a correlated decline. That's in fact more the norm than the exception when it comes to risk off. So this one-year deep out of the money put for 120 basis points might come in handy in a sequence of developments in which stocks fall, stocks become more correlated, implied vol rises, and rates fall fast in the process. Let's see, delta, gamma, vega, and rho. 4 risk characteristics working in your favor there altogether. Don't even get me started on Vanna and Volga. As Les Grossman said in Tropic Thunder, lots and lots of money. Playa. I'm no market doomsayer, and the reality is we can always point to 10 sources of potential trouble for risk assets. The world does feel like a treacherous place, as our media never fails to remind us. But here we are at an all-time high in the S&P, and perhaps on the dawn of something truly special on the technology front. I only point out that the cost of insurance is near an all-time low. It's worth spending some time evaluating. And this, my friends, brings us to number 20 of our 25 sayings on vol and risk. And that is that, quote, price is the only fundamental. Sometimes attributed to Soros, but I cannot verify. It certainly jives with his theory of reflexivity in which market prices condition behavior as they create or destroy wealth. Feedback loops result. As we explored in the risk of missing out, for fund managers, the need to track the S&P can be a source of demand for a market that is rising, irrespective of whether the rally leaves asset valuations expensive. By the way, is there some irony in the fact that the name Soros is the same backwards and forwards? The palindrome, as they call it. Market prices are not merely an outcome, they are a cause. The reflexivity of price is powerful, unavoidable. I'm wondering what the price action in NVIDIA, up 60% year to date, has done for the community of analysts. Soros may or may not have said that price is the only fundamental, but he most surely did say that, quote, "When I see a bubble forming, I rush in to buy, adding fuel to the fire." Tendies, anyone? GME is an amazing example of a scenario in which price is the only fundamental. There are 2 ways to look at this. First, the obvious one is Roaring Kitty's stampede of Reddit bros engorging on Gamma. But there's a second corporate finance angle here. The stock goes up to unimaginable levels, and it actually creates real space for the company itself to maneuver. For a brief period, the market cap of GME exceeded $20 billion. To be sure, there are various restrictions and considerations, but my goodness, monetize the living daylight out of that lofty share price. Ditch the game cartridges, issue shares, and build a casino. It's a much easier way of separating people from their money. There's another way in which price is a fundamental, and that is in polling. Perhaps nothing is more reflexive than polling. Think about the saying, quote, "You're throwing your vote away." Polls tell you this is the case, and then, in your reaction to the polls, makes it so. polls clearly impact what politicians decide to do as well. There's no path forward for me, bemoaned DeSantis, Christie, and Vivek, all conceding the inevitable for Haley as well. Polls are some version of implied probability. Inexact for sure, but certainly better than an analyst's one-year price target. Predictit and other betting sites take polling even further, reflecting prices at which one can transact. Let's consider some recent action on this front. The Biden classified documents case and the resulting disastrous, hastily arranged press conference in which our sitting president argued with the press and mistook the president of Egypt for Mexico saw a big sell-off in the probability that Biden would be the Democratic nominee. He was at 86 and is now down to 73. Ticker symbol is PRIT-USDB on Bloomberg. Now, you'd expect on first thought that a sell-off in Biden would be a jump in Trump. Not the case. From Feb 3rd to today, Trump's odds of winning the election have gone from 43 to just 44. The read-through, the Dems could replace Biden and still win. And that brings us to another upcoming poll, which I think is worth watching. In a New York Times opinion piece titled, quote, Biden is in danger of losing Michigan and with it the whole election, Michelle Goldberg makes the case that Biden's complicated relationship with Israel leaves him highly vulnerable in Michigan, a state with a large Muslim population and one that many argue he must win. As the Michigan primary fast approaches, there's a campaign called Listen to Michigan, which aims to send a signal to the president by voting uncommitted. This should be interesting to watch as it may further reinforce the still pretty unlikely idea that Biden must be replaced. It could also lead Biden to make a hard turn on policy. Polling results are pretty powerful agents of how we make decisions. I've reached the magical 4,000 word count. And with the confidence of Joe Cassano, I can't see within any realm of reason how I didn't get you in and out of here in under 30 minutes. We've completed sayings 1 through 20, 5 more left. I hope this has been useful to you and I've succeeded in giving you some things to consider in the world of risk. Be well and have a great week.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again and catch you next time.